Securing a mortgage can be grueling, and mistakes can cost you a bundle. That's why I always ask potential customers one question: have you been pre-approved for a mortgage? Jeannine Henrion, you're a mortgage originator at our friends at Group 1 Mortgage, and it can be a simple process being pre-approved for a mortgage.
It doesn't have to be difficult, Curt, but the key is to start out early. Get with either myself or one of my colleagues at Group 1 and talk to us about your situation. We can tell you the preliminary documentation that you need to pull together.
Some pay stubs and
absolutely,
proof of
2
a job.
years tax returns, your W-2s, show us that you have money in the bank for your down payment, and make an appointment to come in and meet with us, or set aside 20 minutes to spend on the phone.
Because if you find a house you really like, you'll want to be able to tell the homeowner that you have the wherewithal to buy that home.
Most realtors are not going to take a client out looking for homes unless they are pre-approved, and very often I have the seller's agent call me with the pre-approval letter, double checking to make sure I've really seen that client's tax returns and I've really seen their recent pay stubs, and just, especially if it's a competitive situation for that dream home, those sellers agents are absolutely doing their due diligence to make sure that their seller doesn't take the home off the market and not have it closed.
Now, I could think that I have perfect credit and I would have a breeze getting a pre-approval, but there are pitfalls that can be stumbled into.
That's true. I've had clients tell me in the past, I just bought a car and I had credit in the 700s. Well, depending on why your credit is being pulled, there might be a different formula for scoring you. If you have a very good credit score when you're purchasing a car, that means you've had exemplary payment history on your car loans. But maybe it's not weighing so heavily that you were hurt a few years ago and you still have medical collections that keep cropping up. So they're weighted differently, and you want to be proactive about that in case anything comes up that you can be addressing before you find that dream house.
And your taxes can also be a pitfall here too, especially when you're taking deductions.
That's very true. More frequently than I like to think about, we may meet with a client, or over the phone they'll tell us, I make $50,000 a year. If they don't get us their tax returns in a timely fashion, we can be blindsided, not so much that they didn't make $50,000 a year, but maybe they have taken unreimbursed expenses. If Bob Smith works at a company where they're having a trade seminar in Las Vegas, and he writes off everything he does in Vegas, not just the hotel room, not just the cost of the seminar, the plane ticket, what have you, but every entertainment place he went, every cocktail he bought, and it's a $10,000 trip to Vegas. Well, that's $10,000 subtracted from his $50,000 in earnings, so now we can only qualify him on $40,000.
So what goes on in Vegas doesn't always stay in Vegas.
No, it can impair your ability to buy a home. So you want to make sure that you're consulting with your accountant and really only writing off absolutely what you should.
Jeannine Henrion of Group 1 Mortgage, thanks for being here on South Florida Real Estate Update.
It's my pleasure, Curt.